Welcome to TheoTrade. This is Don Kaufman. December 7th, 2022. Just about 25 minutes ago to the cash close here on this Wednesday afternoon. Some sell-side activity gripping hold of the marketplace, well, throughout the course of the week, really has us asking the question, are markets in the midst of repricing downside risk? Before we go any further, it is critical to mention we are sitting specifically on what we term a gravity point, 39.31. Wow, as I actually record this, we couldn't be closer to that. Basically trading on the gravity point. For those of you, maybe you're a little bit newer to TheoTrade. What is a gravity point? It is not per se support and resistance. It's, if you will, kind of like a seam where risk goes to die. Allow me to show you here on a much broader time frame. What you're actually looking at is precisely where I initiated and drew this price level of 39.31. It was all the way back in the May timeframe. We identified what we kind of term a seam inside of the risk. And that effectively means, all right, this is just a very key level where risk starts to kind of abate. There's not a lot of volume at that particular level, okay? But breaking off that level, either higher and or lower, would actually see spikes in volume, considerable amounts of trade to be able to break off, okay, the edge of this particular level of the 39.31. Now, any gravity point is probably going to have anywhere from about 10 to 12 degrees of freedom. What that would imply, if the gravity point is 39.31, oh, you can actually rally about 10 points, 10 to 12 points higher, 10 to 12 points lower before we officially would break off, okay? The signature, if you will, of breaking off of a gravity point, for example, if we were to rally higher here into the close today, getting up in and around, let's say, the 39.44, there would be a massive spike, again, a massive spike of volume amounting to anywhere, okay, even in a slow day, to 7,000 contracts. Again, that would be that signature, if you will, of breaking off the gravity point higher, okay, and or possibly lower. The interesting thing is we've actually gone back and done a huge amount of regression analysis involving gravity points, and there really is not a directional bias associated with gravity points. So even though right now, of course, we've seen some sell side activity in the markets, and I would love to be like, I'm all bared up. I am longer term bearish. In the short term though, meaning like, the remainder of this week, listen, we've been a catalyst driven marketplace unquestionably, okay? The other aspect that really resonates with me is we are right on this 39.31, which does, in fact, you're like, oh, it's the lower end of the range, but okay, it would just open us into a lower version of a range, okay, a range that included, if you will, a volatility box in the marketplace. Anyway, with that being said, again, this 39.31 is a critical and central place of trade that has been very transparent, as I said, since effectively late May. Breaking substantially below it would in fact be incredibly bearish. Speaking of incredibly bearish for the marketplace, let's immediately cruise right over here to the SPX. And the reason we want to actually dive into the SPX pretty much first and foremost, which is unusual. I mean, on a Wednesday kind of evening video, most of the time I spend the last few moments talking about the SPX and the expected move, but here, the expected move, okay, it has got to take, all right, center stage. It's just, this is like, hey, one of the most important things to understand is this week of trade, all right? This center line that I'm highlighting right now, that was the starting place. The week of trade held plus or minus approximately a $66 anticipation of movement, right? $66 higher, $66 lower. Where are we right now? Okay, outside the expected move. But interestingly, kind of ironically, okay, we're almost perfectly, like not one, but two standard deviations, all right, to the downside. If you take a look at $66, we're just outside a two standard deviation move. And at this point, and it's critical to understand this, okay, you could actually lose it here and you could have 3, 4, even 5 deviation moves. It's something that I warned of on the weekend update that the expected move looked incredibly tight. I mean, lo and behold, Monday and Tuesday of this week, you had moves that were larger than expected for the entire week. It was supposed to be $66 for the week. You had over that on Monday, had over that on Tuesday. Today is kind of an inside trading day, even though, again, there's still quite a bit of time left on here, plenty of time for this marketplace to move. Nevertheless, we're at a 2 sigma move. And you have to be kind of on your game at this point. And it's one of the reasons I'm asking, are markets in the midst of repricing downside risk? Because at a point when you're already at 2 sigmas, this is where markets, and again, there's nothing statistically speaking that says we're at a 2 sigma move. It means we're going to go further. Okay. However, the instance of completely breaking apart in the market when you've already made a 2 sigma move is statistically significant. Okay, it doesn't say that we're going to go for it. It does not say that. In fact, the higher probability, okay, is to actually pull back right to this 4,000 level and pull back inside of the expected move. Okay, albeit a very low probability. You can actually already get a 2 sigma move earlier in the week. It can actually then correlate to a complete, if you will, repricing of the marketplace. And it's pretty disconcerting this early on. We are but a catalyst away from, a much more significant move. And I'm just bringing up significant moves that have happened, okay, recently. And these are only like 2 sigma moves. And I'm just showing you there's 2 sigma moves to the upside, 2 sigma moves to the downside, okay? It is incredibly rare to see a 3 or even 4 sigma. And what that would actually imply is instead of a $66 move, times 2 is a 2 sigma move, times 3, obviously, okay, you're looking at, 200-point move down in the SPX would actually be, an implication of a 3 sigma move. And frankly, okay, what are we? Right now, 50 to 60 points off of that. So it's something that you need to keep in mind, because at that point, it's almost like the markets would be saying, hey, we've got this wrong. We're going to completely reprice ourselves prior to next week's CPI and next week's, of course, Fed meeting. The concern at this point is maybe the markets are getting it wrong, okay? Maybe the markets right here, right now, are trying to reprice themselves. There's some really funky things going on in the marketplace. And by funky, I mean, when was the last time that you saw bonds up and up this substantially with the S&Ps? And S&Ps are not down big today, but the S&Ps have been down, pretty dramatically in the last 2 trading sessions. But instead of bonds selling off with markets selling off, all of a sudden, okay, we're now rushing back into bonds. At the exact same time, you've got to be looking at oil. Oil is getting annihilated, which, okay, for all intents and purposes, this is actually one of the catalysts that's driving the S&Ps lower, because oil is pricing in. It doesn't matter what the catalyst happened to be. And by the way, in this case, it was actually China's data. Okay, neither here nor there. Catalysts are setting off the market, but this is a sign of an economic slowdown. Obviously, the S&Ps, okay, are feeling the pinch of that. And if it's an economic slowdown, right, it would make sense that the bonds would rally. So all of a sudden, we have shifted gears dramatically. And that's why I'm saying our market's in the midst of completely repricing and some of the downside risk. To me, the answer is absolutely unequivocally yes. I think markets at this point have realized, wait a second, I don't think we calculated the recession risk, okay, very well. And they're actually going through a phase right now where they're starting to account for whoa, this could be a recession. This could be a recession. Let's actually pull back oil. Let's actually start to rally bonds a little bit, which is exactly what's kind of transpiring. And the S&Ps, yeah, their pricing is just a skosh too high. But at a time like this, you can get a fairly precipitous break lower in markets. We have not seen that as of yet. I'm not going to call a 2 sigma move inside of the SPX, okay, anything but some short-term volatility. Now back to the SPX for just a second. If you take a look at the SPX and you go out to the December 9th expiration, we still have $54 of movement priced in, and that's predominantly for just Thursday and Friday. So, hey, listen, keep your helmet on. The volatility, still only 23%. It just, that leads me to believe, right? Well, first of all, it leaves something to be desired, but it leads me to believe that the marketplace is not looking at any more catalysts the remainder of this week. Okay, we're not just going to get huge catalysts. Nevertheless, there's still a whole lot of risk on the table with a $54 move and 2 trading days left inside of the week. All right. Some other areas. So we talked a little bit about oil. We talked about bonds. Okay. If you take a look at VIX, hey, listen, VIX is just reacting just a bit to the upside. Don't read too deeply into VIX. Why? Okay, because this is well-charted territory. Like how many times have we been at 39, 31 throughout the course of the year? It's a central place of trade. No one cares in volatility land, right? They're like, whatever, and they'll just continue to move forward. All right. A couple other areas that I would actually keep an eye on. Obviously got some Costco earnings. They're coming out tomorrow after the bell, yada, yada, yada. Doesn't make much of a difference. I don't think that's actually going to be a big mover other than for stuff like Costco, Walmart, possibly Target, but it's not going to move the entire marketplace. But I'll tell you what will, okay? I'm a little concerned right now about Tesla, okay? Tesla at this point, it's looking like it's actually going to break through the yearly lows. So in doing so, I've actually got to bring up a 3-year chart to show you how dire this could actually be. A break just mildly lower at this point could actually lead Tesla very easily into the 150 handle, which would drag down the Nasdaq and the S&Ps considerably. Right there with it, with Tesla, okay, happens to be Amazon. Amazon, look at this. People, that's a 3-year chart, okay? Amazon is basically butting up against some of the recent lows in here. And I mean, we're talking about multiple year lows. In fact, it's even facing, this is the actual COVID low. The COVID low was $81 and change. So with that kind of like mega market cap leaning like that, right, it's not good. Okay. In accordance with that, and a lot of the sell side activity today is brought to you by none other than Apple. Okay. Apple is still more than a hop, skip, and a jump off the lows, but also disconcerting performance throughout the course of this week. If you take a look at auto expected moves, Apple is the disconcerting area here is Apple is not making a 2 sigma move like many of the other stocks inside of the marketplace. So listen, the remainder of this week, hands and feet inside of the vehicle. Okay, you have to know where the lower edge of the expected move is. If we're going to rally, okay, the lower edge of that expected move is about 4,005. And again, when we're sitting right on one of these gravity points, I want to make something very, very clear. There is a ton of risk that is still packed into the remainder of this trading week. But none of it is like really projecting like whether we're going to head higher or lower. Again, when we're on one of these gravity points, as I said, I am absolutely unequivocally bearish, but I'm bearish down the road. In the very near term, when you're sitting, on a, persistent and key level that's been the central place for trade, I feel like there really isn't much short-term directional clarity. Okay, markets, as I said, they're seeking out any catalyst they can and kind of latching onto. And there's been some rough data over the last couple of days, things that kind of surprised us. But right now, the bigger concern is, again, if markets are just repricing this downside right now, trying to figure out like, hey, how bad is a recession really going to be? Okay, what if the CPI actually came in a little hot next week? What if the Fed, I mean, there's a lot of what if scenarios, okay? And at times like that, people don't want to hold positions. Okay, there's conversations going on right now in Blackstone and the REIT side of the marketplace with massive redemptions and them locking down redemptions. None of that, okay, is really good rhetoric for this marketplace. With that, again, it's a huge amount to think about. We're literally sitting on the 39.31. Yeah, this is going to be, again, the remainder of this week, okay, pretty much sitting on pins and needles in the marketplace. Position yourself effectively. We're using a lot of catapult trades, okay? Sit back and defend the risk that you have on. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.